Hello and welcome to our second episode of the monthly roundup from Kepler Trust Intelligence, where we discuss all the news, reviews and interviews from the investment trust sector over the past month. I'm Jo Groves and I'm joined by Ryan Lightfoot-Aminoff to take you through the month of June, which is a bumper one with lots to talk about. So let's start off with a canter through the news. Ryan, you've been covering some of the big stories this month. What stood out for you?
Well, one piece of very big news that came out towards the end of the month was the proposed merger of Alliance Trust and Witan. If approved by shareholders, this would create a trust of about 5 billion in size, making it one of the largest mergers in investment trust history. Now, by way of background, both trusts are global equity focused and have a multi-manager approach. This has all stemmed from the announcement of the retirement of Andrew Bell from Witan earlier this year, who spent nearly a decade and a half at the firm. At the time, the board of Witan said they were considering the options for the future of the trust. And we understand that the board considered over 80 proposals, including considerations of switching to a single manager strategy. That would have represented quite a big change to what Witan has been offering for the past 20 years. Therefore, a change of strategy didn't make much sense. In the meantime, ATST, Alliance Trust, has outperformed the market over a number of time periods. And clearly conversations were had between them and Witan about merging as one of the proposals which has been put forward by the boards.
So clearly this is quite big news in terms of assets, but what does it tell us about the wider state of play in the investment trust sphere?
Well, from a broad sense, it shows that the consolidation in the IT sector hasn't stopped. In fact, seeing something as high profile as this makes it especially noticeable that it is continuing. One slightly tangential point is that it shows that the benefits of having boards is a really good one for investment trusts. Here, the board realised there was little sense in changing the strategy, and actually a merger would make more sense for shareholders. The merger itself ticks all the boxes you'd expect of a decision of this magnitude, so better liquidity, lower charges, and move up the index rankings into the FTSE 100, which will obviously bring in the passive buyers, and that will likely have an effect too.
Right.
We can see from the shareholder register that these trusts are quite popular with retail investors. So the combined vehicle should offer better economies of scale and those lower charges, which are very popular traits amongst retail investors. Now, one of the concerns that has been raised is there may be some question over the cross holdings, that they've got similar holdings in both portfolios, and whether between those they own large stakes of vehicles, which may result in some sell downs. They have addressed this in the announcement, saying they'll be very careful when they sell when it's worked for shareholders. And overall, the merger strikes us as a very sensible decision. In the end, it will leave a trust that is a large one-stop shop for investors who like to get access to active management without having to worry about allocating or monitoring. So we do think it will continue to have appeal.
Thanks for that. And elsewhere in the news, I believe you have some, if I could put it this way, not news.
Yeah, that's correct. Our second piece of news is quite oddly something that didn't happen.
Right.
We saw in June a roadshow for a potential IPO of what was called Special Opportunities REIT, SOR. They were hoping to raise £500 million in total to put to work in what they called high quality but undermanaged UK commercial property. A UK commercial property has been under pressure for a number of years now. Retail sector, which falls under commercial property, has been severely affected for a while with the big increase in internet shopping. Office, which is again part of it, has been impacted by the increase in working from home. And now the sector, even more broadly, has been hit by interest rates. Lots of property trusts have fallen to a discount to account for this, as investors are sort of questioning whether the NAV valuations are accurate. These are very difficult to ascertain as the deals don't go through often, so it's difficult to compare valuations. However, SOR was launched because the managers of it believed there were lots of significantly undervalued opportunities going on. They wanted to raise this capital to try and take advantage of this. They had a strong cornerstone investment from the likes of Columbia Threadneedle, Golden Tree, Asset Management, and a family office, raising just over £100 million. Although ultimately the IPO did fail to get the minimum 250 it needed.
So what do you think that tells us about the state of REIT investing?
Well, the failure to launch is disappointing, but it is at least a sign of some optimism coming back to markets. The sort of brokers who were taking this round had enough confidence to do an IPO roadshow, which would have been quite laughable 12 months ago, really, with interest rates where they were. Now, we don't know the exact figure of where the roadshow got to. The fact that there were big cornerstone investors show there is appetite out there for property, and that the depressed valuations are being seen as an opportunity by many. However, we believe that there are plenty of opportunities already in the space. A number of established trusts with great track records are trading at discounts, and this potentially could be a good opportunity rather than the slight premium they would have paid on SOR at an IPO. One of these trusts is TR Property, that comes on the TRY ticker. The manager, Marcus Fairmudge, was actually a cornerstone investor for SOR, so he clearly believes in this opportunity of valuations out there. TRY is trading around an 8 or 9% discount, despite its really excellent long-term track record. So that's one opportunity to point to. Another is Schroder Real Estate, which is trading around a 28% discount, so much wider there, and it's yielding around 7.3%. So we believe that trust offers a really compelling value opportunity in the commercial property space. So while this news hasn't really changed much, it shows that there is some appetite for commercial property, and maybe if we do start coming into a rate-cutting environment, we could see a recovery in the sector.
So now turning eastwards, there's been some news from Schroder Japan regarding its dividend and discount. Can you talk us through this?
Of course. So Schroder Japan has announced a new enhanced dividend policy, as well as a tweak to its discount control mechanism. This comes on the back of the increasing importance of dividends from the Japanese market as corporate governance reforms begin to have an effect. SJG has grown its dividend by around 12% per annum over the past decade, so really strong growth anyway, but is now committed to an enhanced dividend policy that will pay a dividend of about 4% of NAV, with a contribution from capital to supplement the natural income of the underlying portfolio. The trust, as of time of recording, yields around 2%, so this marks a really significant jump in the income profile of the trust, and will make it one of, if not the largest yielder in the Japan sector. Furthermore, the board has amended its tender offer in order to try and help narrow the discount, which currently stands around 10%. The previous tender offer required outperformance of the benchmark, which the trust comfortably met in May 2024. This has now been renewed again for the next 5 years, meaning there will be a tender offer for 25% should NAV not outperform the benchmark over that 5-year period. The reason this is a bit of a standout feature is this is not common in the Japan sector. It's one of the only trusts that does it. Therefore, the commitment to sticking to this policy and returning a very high percentage to investors is quite notable in our opinion. Just one final note that this is in addition to the share buyback policy that is already running with the trust. The past financial year, the board authorised a buyback of just around 2% of the share count, which would have been accretive to NAV. These two changes bolster the investment case for SJG. The trust is benefiting from a really supportive backdrop in Japan with the likes of its corporate governance reforms and using cash better. All saying that SJG has significantly outperformed the benchmark and is vying for top spot in the sector over 5 years. So really good performance and some changes in its policies, which are more investor friendly as well.
And if you'd like to find out more information about Schroder Japan and the new policy, we've just published a podcast on this topic on the KTI website.
So that's our highlights from the news. So moving on to some of our reviews. Joe, you've been covering our very popular small cap event that was held earlier this month. Would you like to talk through some of the takeaways from that?
Absolutely, yes. We held a series of webinars with fund managers themed around the lost decade for small caps and therefore the potential opportunity for investors in that space. If you didn't manage to catch the webinars, all the recordings are available on the KTI website. And as we both know, Ryan, small caps have historically outperformed their larger peers over time, but undoubtedly they have struggled since the pandemic, and we see many small cap investment trusts currently trading on double-digit discounts. So we had Nish Patel, manager of the Global Smaller Companies Trust, opening the event, and this is one of the few small cap trusts with a global remit. So he talked about the potential for mean reversion to long-term outperformance after a significant period of underperformance, which we've certainly seen. He also spoke about smaller companies typically accounting for around 7 to 8% of overall US stock market value, but this has fallen to 4%, and he pointed out this has historically marked the cyclical low, but also the start of the recovery period, which has often been a lengthy one. Also talked about valuation discrepancies between small and large caps, not only in the UK and Europe, but also in the US. I guess the million-dollar question is what the catalysts are in terms of small caps coming back into favour with investors. And Nish spoke about three potential catalysts. So the first being a possible change in sentiment towards the Magnificent Seven. Possibly it's going to become more difficult to sustain the current levels of growth that we've been seeing. And Nish potentially believes that this deceleration of growth may not be fully priced into current valuations. And also, we've spoken about this in previous podcasts, the market cap of the Magnificent Seven is almost 4 times the size of the entire US small cap market. So, a relatively small change in allocation to the Magnificent Seven could have a significant impact in terms of small cap valuations. And then in terms of other catalysts, he talked about interest rate cuts. So we've seen the first one in Europe and Canada. Hopefully we will see UK and US cuts in the later part of this year, and these lower rates should be more beneficial to small caps. And then the third catalyst is the cash flow deployment in terms of bumper share buybacks, as we've seen, and also elevated M&A activity. I think just one last point on this one is, in terms of income, there is a bit of a tendency for income seekers to focus on the FTSE 100, which, as we know, is jam-packed full of blue-chip high dividend payers. But that ignores that small caps can actually be highly cash generative and offer a very good dividend yield. And actually, on that note, the FTSE Small Cap Index is currently trading on a higher dividend yield than the FTSE 100. And also, before we leave that particular webinar, it's just worth noting that the Global Smaller Companies Trust is an AIC dividend hero, so it's had more than 50 consecutive years of dividend growth, which is obviously impressive.
Very interesting, thank you. It's a great stat on the dividend yield of smaller companies, something that many investors probably wouldn't have considered.
Absolutely, yes.
Now, sticking closer to home, we also heard from Gervais Williams at the event. He's the manager of the Miton UK MicroCap Trust. What are some of the interesting things that came out from his webinar?
Yes, in some ways a similar theme to that I've just spoken about. So the move from small to large, but Gervais very much saw this as finite in scale. So again, coming back to the dominance we see of the Magnificent Seven, he talked about potentially obsolescence risk can be miscalibrated in a highly competitive market such as technology. We could see share prices flatlining or even potentially going downwards. He also talked about annualized returns for individual companies tending to group around the average over time, and that outliers on the upside are actually relatively rare, but they are, however, more frequent in the microcap space than in the large cap space. So again, something to bear in mind. He also talked about the link between investor behaviour and the shift we've seen from globalisation towards nationalism, and also how geopolitical issues, and we've obviously seen a number of these over the last few years, can affect different sectors at different times. So we've seen bond valuations decline, we've seen energy prices go up, and potentially there's a benefit in being diversified across sectors rather than, for example, having all of your eggs in the technology basket. And in terms of valuations, Gervais sees UK microcaps as trading on absurdly low valuations, in his words. Significant corporate buybacks haven't typically been a feature of the UK microcap sector. And also we've seen a lack of interest from overseas investors. So that's the position we find ourselves in terms of valuations.
Something we've heard a few times.
We have.
And finally, we heard from Joe Bauernfreund from the AVI Japan Opportunity Trust.
Yeah, so over the last 5 years, the small cap index in Japan has underperformed the broader topics index, particularly over the last 12 to 18 months when we've seen the topics take off. We've also seen capital flows from investors reverse, and this has left a valuation gap between small and large caps. And Joe talked about the benefit of the cash-rich universe in Japan, so we're seeing companies with stronger balance sheets outperform, but also potentially they're the most undervalued. So if that's the what, I guess the next question is the why. Despite recent performance, I think foreign investors are often still underweight Japan. Joe also spoke about having a large universe of listed companies in Japan, possibly too large, which he felt was a function of the perceived prestige of being listed in terms of Japanese companies, but also a general aversion to being taken over in terms of corporate activity. And as we've spoken about on other occasions, lack of sell-side analyst coverage, which, if you're a stock picker, is an opportunity. I think the hoarding of cash on balance sheets, which again has been a feature in Japan, meant that cash ended up being structurally discounted. But we have seen regulatory changes to address this. We've also seen wider corporate reforms to improve shareholder value. And as a result, share buybacks have hit record highs. And Joe pointed to the opportunity for shareholder activism, but also making sure that you engage in a way that's sensitive. It's a different corporate culture in Japan, so a need to try and instigate change, but without naming and shaming the management team along the way.
Thank you, Joe. And on the back of the success of that event, we will be having a couple more trusts returning to our screens as an encore later in July. Invesco UK Smaller Companies, Brown Advisory US Smaller Companies, and Aberdeen Asia Focus will be talking through their approaches. So if you'd like to listen in, please register on the website. Now, moving on. In last month's pod, we talked about the results of SOI, Schroder Oriental Income. You've recently interviewed the manager, Joe, Richard Sennitt, for our Trust Issues podcast. What insights did he have on the sector?
Yeah, so just as a quick overview, it offers investors a diversified source of income, but it also offers capital growth. And it's achieved 17 consecutive years of dividend growth. So it's in the AIC Next Generation Dividend Heroes. I think Asia is often overlooked by income-seeking investors, despite actually having quite an attractive dividend yield relative to its peers. And this is a topic that Richard spoke about. So we all know that Asia has strong structural growth drivers. It's got a growing middle class. It's got favourable demographics, and as we know, it's home to some world-leading companies. And Richard acknowledged that while investors often look to Asia for growth stocks, they may overlook income as part of that, and actually income often accounts for a significant part of total returns, in many cases over 50%. He also talked about a kind of general preconception by investors that when times become tough, potentially dividends in Asia might be cut more sharply than in other markets, but actually he felt that dividends are quite durable, particularly if you look back through dividends paid during the global financial crisis and the pandemic. Part of this he felt was due to the low dividend payout ratio relative to historic levels, but also low gearing. So that means potentially when earnings come under pressure, there just isn't that same immediate need to cut dividends.
And what was Richard's view on the recent performance of Asian equities?
Yeah, Richard spoke about Asian markets being up mid to high single digits in sterling terms over last year, but lagging global markets. But they have started to do better in the last few months. I think he thought part of this was due to China rebounding from a relatively oversold position, but also the outperformance of value against growth has been a tailwind for an income strategy such as SOI. Richard also spoke about the likely benefit of interest rates peaking and also the US dollar easing, which could be a driver of positive sentiment towards Asian equities.
And what parts of the market does Richard find particularly interesting at the moment?
Yeah, I think firstly the technology sector. So we've got some strong structural growth drivers, and also they've got some of the world-leading companies in semiconductor chip manufacturing. So that's an obvious selling point for the region. Probably worth noting that Richard has actually started to rotate or trim some names that have done particularly well, helped by retail interest in the sector, although he doesn't think valuations look extended. And I think secondly, financials, so banks, insurance groups, etc. So for example, traditional high yielding but slightly lower growth companies in countries with higher financial penetration, so for example, Singapore, and these types of stocks have done better from rates staying higher for longer, but also banks in places where credit penetration is at a relatively low stage, for example, in Indonesia. So let's hand back to you, Ryan, for some results that were published this month with a couple of standouts from the infrastructure space.
Indeed, June saw the publication of a number of results pieces in which infrastructure featured reasonably heavily. First, we'd like to highlight was Cordiant Digital Infrastructure, CORD, which is the ticker. They released their annual results for the period to the 31st of March. NAV per share increased by 7.8%, with a total return of 9.3% based on the ex-dividend opening NAV, which is slightly ahead of the Trust's target of 9%. The Trust completed 2 acquisitions in the year to take the number of portfolio companies to 5 across a mix of towers, data centres, fibre networks and sensors. This has helped improve diversification of the Trust and has shored up the income as well. This has allowed the managers to increase the dividend by 5%. Now, this is the second time that the dividend has been raised in the Trust's very short history, so we believe this reflects the really conservative approach the managers have taken and the fact they've been able to beat those goals, and it's a good sign of progress in the strategy. At the moment, the trust yields around just over 5%. Since the results, the trust has announced a refinancing of its gearing facilities. The gearing at the date of the trust was 39% based on a GAV basis, about 64% of NAV. This remains below the 50% limit on the GAV basis that they set for the trust. Shares did react positively to the announcement, as you might expect. They rose significantly on the day and have since slipped back just a little bit, though the discount remains very wide at 37%. We don't believe this reflects the strong operating performance of the portfolio, nor the potential for the income either.
And staying on the infrastructure theme for a little bit longer, we also saw results from Sequoia Economic Infrastructure. What highlights would you like to draw out there?
Yeah, we saw Sequoia results come out on the 26th of June, again for the year to 31st of March. They saw NAV growth, again ahead of targets, with a total return of 8.1% against their goal of between 7 and 8%. Now, by way of a bit of background, Sequoia owns a highly diversified portfolio of loans. These are invested against areas like digitalisation and the energy transition to more long-standing asset types such as railways and ports, all of which have an economic link. Private debt accounts for the vast majority of the portfolio, as this offers an illiquidity premium to publicly traded debt and allows for the high returns that the trust has generated. They sort of fill in the gaps where these firms otherwise can't get financing.
Yeah.
And one of the changes in the results was the increase in fixed rates to just under 60% of the portfolio. This is to capitalise on the current high level of interest rates in anticipation of their fall. This should be supportive for the dividends, which is already fully covered by revenue. The trust currently yields around 8.5%, which we believe looks particularly attractive, especially if interest rates begin to fall comparatively. The managers actually reduced the number of investments as they wanted to use the cash to lower their own gearing as well as undertake share buybacks, but the portfolio does remain incredibly well diversified. The trust trades around a discount of 16%, so this would have been accretive to NAV, the share buybacks, as well as supporting the share price. The trust has been impacted in the past by a few non-performing loans. In the year, managers made really good progress on these, though, including the expected full recovery of a loan to Bulb Energy. We think Sequoia offers a considerable potential for strong total returns, especially in a falling interest rate environment because of that high dividend yield, with some potential capital upside from the pull to par that you'd expect of this asset class. So there's a really good potential for the narrowing of discount and, in the meantime, a really good dividend from the trust.
Many thanks for that, Ryan. And that's it for this month's podcast on investment trust news. We hope you join us again soon. And if you have any suggestions for content you'd like us to cover in future podcasts, please drop me an email at joe@keplerpartners.com. In the meantime, there's more information on topics we covered today on the Kepler Trust Intelligence website.
Past performance is not a reliable indicator of future results. The value of investments can fall as well as rise, and you may get back less than you invested when you decide to sell your investments. It is strongly recommended that if you are a private investor, independent financial advice should be taken before making any investment or financial decision. Please be aware that there can be a time lag when we release podcasts, meaning time-sensitive information may no longer be accurate at the time of publication. Kepler Partners LLP has a relationship with some of the companies covered in this podcast, which may impair its objectivity. Kepler Partners LLP is authorized and regulated by the Financial Conduct Authority.